Hi, my name is Yasha and I help young men invest in the stock market. So today we are going to analyze General Motors company with the stock ticker GM because first of all this is a very famous company that produces cars, and second of all they had earnings report today which surprised everyone. They reported better results that we all expected. So let's take a look together at this company, whether we should buy or sell it, okay? Now, this video is perfect for you if you want to know whether you should buy or sell General Motors, or if you are a beginner and you want to just know how to analyze stocks, okay? Now, as always, we are going to analyze General Motors using this little Canva presentation that I have right now here. So let's begin, okay? First of all, why should you even listen to me? As you know, my name is Yasha and I help young men invest in the stock market. And when you have more trust for me, the first link in description will take you to my one-to-one coaching. So see you on the other side, okay? Now let's begin with the analysis. So this is going to be very simple, beginner friendly, straightforward, without any bullshit whatsoever. So grab a piece of paper, grab a pen, because you will learn a lot. Now let's begin. So whenever you analyze stocks as a complete beginner, you should always care about the following 6 things. You should care about chart, profit, debt, money on the bank account, value, and price. Now here we have some quick facts about General Motors. It's an automobiles company that was founded in 1908 and it's very famous in the United States. We Europeans, we also know it, but we don't have that many cars from the America here, okay? And here we already see the first thing, or at least the first detail that we should pay attention to. It was founded in 1908. What does that mean? The older the company is, the better it is and the safer it is as an investment, okay? So as a rule of thumb, whenever you analyze or whenever you think about investing in the stocks, invest in those stocks that are older, because these companies have been time proven to survive the crises, okay? For example, General Motors is here already like 100 years. So for them, we already know that they survived at least 5 different crises, okay? For example, like the Great Depression, then the Black Friday, dot-com bubble, 2008 real estate crash, coronavirus, and so on and so on. So they survived at least a couple of crises. So and they are still here after that time. You know what I mean? So the older the company is, the better, okay? Preferably you invest in companies that are older than 100, that were established before 1950, 1960, 1970, like in that region, you know, because we know that those companies have better chance of survival because they are already here for a couple of years, you know, like it's logical, okay? So now we go to the chart, and for chart we also have an instruction that it has to grow for all 10 years. Now all of those instructions were written by me when I analyze stocks for myself, okay? So just follow them and you will be okay. Now what exactly does that mean? That means that I will draw a little exponential line, kinda like that, and we are going to compare the stock price chart, which is the orange line, with this black line, and then we will see whether the company grows or not, okay? Because we want to invest in growing companies that are profitable, that will bring also us money in the future, because we are in the stock market for the money, because we want to get rich. It's that simple, okay? Now what do we have here? Here you can see that the chart was actually growing quite well until 2022, where Ukrainian war happened, and then stock completely dropped, and right now it's slowly going up and up and up. So generally I think that this chart is actually quite well. The company is growing slowly, so we might see right now the chance to like reinvest or maybe start investing in inside. Okay, let's see what the other topics are, but from the chart on it looks good. Okay, now let me just quickly draw you what should be the best one. So the best one would be kind of like that, you know, up and down, up and down, up and down, up and down, but it grows. Okay, this one is quite similar. Okay, here it was straight and then down, up, then down again and up again. Yeah, okay, I mean it's fine. Okay, now let's come to the profit. And for profit, we have an instruction that it has to be in plus and it has to grow as well, okay? Now here is the very same story as with the chart. We will draw a little exponential line, kind of like that. And now let's compare the profit chart with this line. And immediately you can see that we will not compare it anymore because we have one major red flag. Year 2017. What do we have here, my little bro? We have a loss. And whenever we have a loss in the profit chart for the last 10 years that we analyze, that's immediately a no-go. Immediately, like whenever I see a loss in profit, I forget about the stock no matter how good it is. I don't care about it anymore. So for me, like the whole story stopped here. They have a loss. I don't care about what happens now further on, but that's it. They have a loss. I'm gone. I'm out of here, because we want to invest in profitable companies. Like whenever we invest in a company, we literally give them money. And if they make loss for us, then we lost that money. You know what I mean? Like you invest in legit businesses, you become co-owner. Would you like to have a company that brings you loss? Of course not, okay? So whenever you see that, forget about it. No go, okay? Now for the sake of the video, let's continue. Let's teach you how to analyze different topics. But for profit, whenever it's loss, it's gone, okay? Goodbye, honestly. We are harsh because we are talking about our hard working money here, okay? That's why we are ruthless when we analyze the stocks. Okay, debt has to be low and preferably it should also decrease through the years. What do we have here? Here we have exactly the opposite. Here we have a growing debt, okay? Now, in this company, that doesn't necessarily mean that it's a bad thing because I will show you now here a detailed analysis and you can see retained earnings are growing. What are retained earnings? This is the money that the company reinvests back to expand the business. So if they are growing, that means that also they used debt to finance the growth, okay? So in this case, it's actually okay, but it's still growing, so we will mark it as a no. You know what I mean? Because think about yourself. Would you be happy if you have more and more and more and more debt? Of course not. You want to live debt-free life because debt gives you stress, troubles, you become emotional, and then you don't do sound decisions, you know what I mean? And the same is with the companies. High debt is bad. It's that simple, okay? Now we come to the money, and for money, we literally measure money that they have on the bank account. Just like you. You have right now maybe $500, $600 because you are a young man and your grandma gave you the money to buy sweets, but you decided to invest in this market, okay? And you have that money on your bank account. And here is the same. We measure the very same money on the bank account, and preferably they should have more money than the costs, okay? Because that means that whenever something unexpected happens, for example, one car breaks and then there is the whole scandal and everyone talks about it, the stock drops, the production is fucked up. So when that happens, when something unexpected happens, okay, if they have money in the bank account, they can spend it to solve that trouble. But in our case, what do we have? We have negative bank account balance, okay? Look, minus $4 billion on their bank account. Is that good or bad? Use your brain, you are smart. That's bad because if something unexpected happens, they need to take more debt to repay that unexpected event, plus all of the debt that they have already, okay? So positive bank account balance is what we want to see. We don't see that here, so debt is also, money is also bad, okay? Now we come to the valuation, and obviously we want to invest in stocks that are undervalued. We are measuring valuation by two things. First thing is called P/E ratio, and the second one is called intrinsic value, okay? Now, what does P/E ratio actually mean? We use P/E ratio to compare the earnings with competitors and the whole stock market, okay? So generally, we want to see P/E ratio lower than 15 because 15 is the average P/E ratio of the whole stock market. And if we want to buy undervalued stock, it should be lower than 15 because It's lower than the market. It's that simple, okay? Now, what do we have here? P/E ratio of General Motors is 6, which is almost 2 times lower, I mean a bit more than 2 times lower than average on the stock market. So that means that the stock is actually undervalued in terms of the P/E ratio. Now, intrinsic value also measures the overvaluation or undervaluation, and this might sound a bit complicated, but it's actually very simple concept, okay? Intrinsic value tells you the stock price that General Motors should have at this exact moment, okay? Now let's take a look at the example. So based on the calculation, General Motors price should be $77 per stock, but the current stock price is actually around 50, let's say, okay? So it's $50, which means by $27 lower than it should have been. You know what I mean? And if intrinsic value is higher than the current stock price, the stock is undervalued as well, okay? Now what do we have here? Intrinsic value is by $20 or $27 higher than the current stock price, which makes General Motors undervalued stock as well. You know what I mean? Intrinsic value, the price that they should have, and price is the actual price. It's that simple. Now, that's a good thing, so the stock is undervalued, okay? And now we come to the price, and for price we have an instruction that price has to be lower than 150 euros. You are from America, so for you $150 is the same thing. Now what do we have here? Current price is $49, almost $50, which is by 3 times lower than our limit. So this price is also underpriced, okay? General Motors is underpriced. Now 150 is the limit that I recommend you to pay attention to, because whenever you are a young man, you have a tight budget, you have maybe those 400 euros or 500 euros, 600, whatever, from your grandma. And if you buy one stock with that money that costs, I don't know, $400, $500, then you have only one stock with your whole money. But if you buy cheaper stocks that are, let's say, maximum 100, 150 euros, then you buy 4 or 5 stocks. And if one of those stocks drops, but the others grow, you are still overall in plus. But if you buy one expensive stock and it drops, you are in minus. You know what I mean? So it's better to buy cheaper stocks because they are cheap, so we can buy more of them and make more money on the long term. And additionally, you have a bit of additional protection, okay, against the stock market swings and ups and downs and so on, okay? Now let's go to the final evaluation, where we are just going to summarize basically everything that we found out about the company so far. Now, does the chart grow exponentially? It does not, but it grows, okay? So we will mark that as a good thing as well. If you don't believe me, watch the whole video again. Now, does the profit grow? Generally yes, but 2017 represented the loss for the company, which is immediately a no-go for us, okay? Fuck the profit, they made a loss, we are ruthless, nothing personal, it's just business, okay? No matter how my heart shatters when I say that the companies are trash, but I'm sorry to say it, you know? Now, do they have growing debt? Yes, they do, so that's a bad thing as well. Do they have money in the bank account? No, they don't. They have minus $4 billion, so that's another bad thing as well. Is General Motors undervalued? Yes, it is, both with P/E ratio and intrinsic value. And is the price below $150? Yes, it is. Now, what should you do? Should you buy or sell? In my opinion, you should fucking sell this company because of the very same reason that I told you. They had a loss. If we have loss in the last 10 years, the company is bad. We are sorry to say that, but that's the fact, okay? We don't want to invest our money into loss-producing companies because we literally become co-owners of those companies. And me, as a co-owner, so to say, I don't want to see fucking loss, okay? It's that simple. No matter what, if the company is reinvesting the money back, as you can see right now here, no matter what, if the company is slowly growing, it's a loss, bro. I'm sorry to say it. I don't like it. And additionally, car industry is being completely overruled by all of those cheap Chinese cars. Like just a few months ago, I saw one new car company, completely electric, here in Madrid, and I was thinking, okay, where do they come from? Of course, from China. China is ruling the world, unfortunately, at least in the car market, because European Union is just putting so much shitty regulations that our companies that are, I mean, we need to adapt it and so on and so on. Whereas Chinese are quick, they make the cars for 500 euros with production cost, whatever, I don't give a fuck, and they put it on the market, you know. So car industry represents the problem, loss represents the problem, and additionally, they decrease the dividends, which is bad for us dividend investors, okay? They have minus on the bank account, so I am not interested. I'm sorry to say it, but yeah, in my opinion, I would not buy it, okay? Now, if you are more interested about stock market analysis, I will invite you to click the first link in description and we will talk about it in more detail. Join me on my journey if you want to become a millionaire with stock market investing as well. Do the hard work and see you on top of the world.